Hello, welcome to the special edition of World Outlook for 2017 with me, Tanveer Gill. My guest today on the show is the author of the famous Gloom, Boom and Doom newsletter, the newsletter that many participants, market participants that is, across the world follow very closely. A veteran investor who is known to be candid and controversial with his market predictions. Dr. Mark Faber joins me today to discuss his outlook for this year. Dr. Faber, it's great to have you on the show. Thanks very much for taking out the time to speak with us. Let me start off, tying into that wish of, saying Happy New Year to you. Do you think 2017 would be a happy year for markets across or would be as dramatic as 2016? Do you think the markets can actually take a breather from the aggressive volatility that hit us all of last year?
Well, I think that in general, volatility will increase, whereby volatility has been quite high in 2016 already. When you look at the beginning of last year, we dropped to 1810 on the S&P, and then we closed over 2,200. So we had a big move in the market from the lows. And then we had currency moves that were very strong. Some currencies went down, but others actually appreciated against the US dollar, in particular Bitcoins, and of course also gold and the Brazilian real and the Russian ruble. So it was a year where you could make a lot of money or also lose a lot of money, depending how you were positioned.
Fair point. Then let's start the interview by understanding your top three views for 2017. Dr. Faber's top three predictions for this year.
Well, for the year, I don't know, but for the near future, and we have had some big moves recently, I have essentially three views. First of all, I think that the US economy is like a super tanker or a sailboat. It's not easy to turn it around and come back to where you've been in terms of prosperity. So I think that in general, Mr. Trump's policies will fail to lift economic growth rates significantly. I think that US stocks, if I compare US stocks to emerging markets or US stocks compared to European companies or to Japanese stocks, I think that US stocks are significantly ahead of themselves, and that in 2017, as has happened actually already in 2016, emerging markets will outperform the US, either by going down less than the US or by going up substantially more than the US. So I would essentially avoid the US and rather invest in emerging economies, including India. Now, the second view I have is that recently investors have been obsessed with growth in the United States and with interest rates going up, because the Fed has said that they would essentially increase the Fed fund rate 3 times this year. But the bond market in the US, the Treasury bond market, is grossly oversold. And so for the next 3 months, I think we can have a rebound in US Treasuries. In other words, short-term interest rates and long-term interest rates in the US are rather going to ease again in the next 3 months. And so I think that you could get the 5 to 10% upside move in US Treasuries. And the third view I have is the whole world seems to think that there is only one way the US dollar can go, and this is upward. I doubt this is to be the case. First of all, if you have a strong dollar, the trade deficit in the US and the current account deficit are likely to weaken, as well as the economy. And so I believe that within the next 3 to 6 months, or even already now, the US dollar has become rather vulnerable against foreign currencies. So I would rather be short the US dollar in 2017 than long the US dollar. I think that precious metals, if I look at the sentiment of investors towards precious metals, it's actually puzzling because gold is up against the US dollar, and gold shares are up something on average by 60 to 80% in 2016. But despite of this performance, investors are very bearish about gold and gold shares. And I think I would accumulate or recommend to accumulate precious metals stocks and the physical in 2017.
Right. Dr. Faber, clearly then you are circumspect about the US economy and the markets. A growing camp, however, believes that the US has embarked on a new bull run. The last 2 months are testimony of that optimism. Do you think that under Trump, this is just a hope rally that will fizzle out or meet eye to eye with the reality of the US economy this year itself? I mean, you have stated that the US market is looking stretched. And by March 2017, the US markets would have entered or completed actually 8 years of a bull run. And typically a bull run lasts about 4.5 years, maybe, stretching it out to 5. But, a big camp in the market believes that this time around, even though the bull run has extended itself, the US market and the economy could be seeing what's typically called the super bull run. I mean, many are drawing the comparison with the kind of bull rally the US markets witnessed in the 1990s, which actually lasted 9 years plus. So how do you rationalize that optimism, which is fueling US markets higher and fueling the optimism there is on the US economy?
Well, first of all, I'm not interested what most people think, because most people think that Britain would reject Brexit, and most people believe that Hillary would be elected in the US. And so I'm truly not particularly interested what the majority thinks. But I'd like to make a comment that the market in 1990, when it embarked in 1991 on its bull market, interest rates, say on treasuries, were still around 8-9%. And we had a big correction in 87, whereby the valuations of stocks in 1990 were not particularly high. Valuations of US stocks today are very high. Also in the 1980s, don't forget, the US market had significantly underperformed emerging economies, in particular also the industrial country of Japan. The Japanese market was the story of the 1980s. So actually by the early 1990s, the market in the US was relatively inexpensive compared to stock markets overseas. But this is not the case at the present time, as I just mentioned to you. If you look at the figures or charts that go back 30 years, the US market has never been this expensive compared to other markets in the world than it is now. And I believe, whether you're contrarian or not, that eventually there is a reversion to the mean. So I believe that the stock market in the US either will go down, but will go down more than emerging markets because we are in a global bear market, or that emerging economy stock markets will go up more than the US if the super bulls are right. But we have very strong headwinds. One of the headwinds is obviously if the economy strengthens a lot, I think that consumer price inflationary pressures will come up and that interest rates will go up. Once the 10 years yield goes to around 3%, I think that the stock market will notice and that stocks will face this headwind of rising interest rates. Secondly, don't forget, if the US dollar is strong, it means that foreign earnings of American companies are translated into yet less dollars in the US, and so the earnings will suffer of multinationals. But also, if the US dollar is very strong, it's a signal, it's a symptom that global liquidity is tightening. And when the dollar is very strong, usually stocks don't perform particularly well.
No, sure, but if you are bearish on the US, then how do you rationalize the Fed hiking rates twice or thrice this year, indicating to world markets that the US economy is actually doing fine? What would be the tipping point of a big sell off if indeed the markets are looking stretched? And if that's your scenario, then I also would believe that you do not see a strong case for a series of rate hikes through the course of this year.
Yes, it is possible. I don't think it will happen because if I look at economic statistics that were published recently, housing is not contracting, but is not growing strongly at the present time. And housing starts in November were down 18% month on month and down 6% year on year. Car sales in the US are weakening. Now you look at around the world at emerging economies, most emerging economies, they're not really in recession, with few exceptions like, say, Brazil, but they're not growing rapidly. I really travel a lot. In some sectors of the economy, there is a recession, not a pronounced depression, but business is lower than a year ago. And in other sectors, it's flat. But in general, we have this asset inflation, which has come essentially in many sectors of the economy to an end. Housing prices in San Francisco are no longer going up from an inflated level, where well understood. Also in New York, high-end luxury is easing and so forth. So there are many symptoms that the economy is not strengthening, but actually weakening already. And if interest rates go up substantially, in my view, that would really choke off an economic expansion.
Fair enough. Then what is the outlook for India, despite you not being a proponent of the demonetization drive? And you've been very vocal about it. You've been very critical of it in the media. What will drive, according to you, interest into the Indian market in this year?
Well, I think that the market has adjusted downwards, and I think we are in a buying range. Let's put it this way. I think the economy, it doesn't matter whether India grows at 5% per annum or 7% per annum, but I think if you look at the next 10 years or so, you could easily expect an economy that on average grows anywhere between 4 and 7% per annum, which is a very high growth rate compared to practically no growth, which I expect in the US or in Europe. So when I believe that earnings eventually track nominal GDP growth in the very long run, earnings cannot expand much more in the long run at nominal GDP. Otherwise, GDP will be all earnings one day and nothing else. So in the long run, earnings expand at roughly GDP growth rates. So my view would be that the valuations in India, the way they are now, are reasonable. But I'd like to add one thing. In the last few years, indexing has become the game in town globally. A lot of money has been invested passively in ETFs that just buy the index. And when I look at 2016, we see huge differences in the performance of different sectors in the US. The best performing sector were essentially gold shares. But other than that, we had energy being the best performer. And one of the worst performer was biotechnology. So I believe the world is now moving back into essentially a stock picker's environment where people who are in the right sectors, they perform very well.
So is oil and gas your big bet? And it makes sense because ONGC's rallied what, close to 40% in the last 9 months, completely under the radar, mirroring what oil prices have done. So are Indian oil and gas assets of interest to you?
I believe in 2017, some commodity-related stocks, including oil and gas, will be reasonably attractive. Probably what I've noticed to be the most attractive sector are plantation companies, agricultural companies, and fertilizer companies. I think they have significant potential on the upside because I expect agricultural commodity prices, which have been very weak since 2011, that these agricultural commodity prices will bottom out and start to increase. So I think the agricultural sector, fertilizers, are relatively attractive.
Since you mentioned earnings and overall growth projections for the Indian economy through the course of the next 12 months, we conducted a poll at ET Now talking about what market participants feel the market can do in terms of pure returns for this year. And a majority believed that the Indian market can make a fresh attempt at record highs in 2017. That is the Nifty going past 9,000. Do you think that is possible?
Well, I'm not sure we'll see a record high right away, but as you know, in the world, we have essentially people that pursue expansionary monetary policies, and we talked before about the Fed increasing rates. I think if the Fed increases rates, they will make sure that the rate increase doesn't lead to real interest rates going up substantially. So if you have inflation at, say, 5%, and you have a Fed fund rate at 2.5%, you're still negative real rates of 2.5%. And I think in India, a monetary policy will be pursued that is pro-growth. And you also have a fiscal policy that is pro-growth, theoretically. I don't believe much in fiscal policies, but this is the view of economists otherwise. And so I think that over time, the rupee will continue to weaken and stocks will adjust on the upside.
But Faba, another key theme which is going to play out in 2017, to my mind, will be the whole monetary policy normalization that we'll see world central banks undertake, initiated by the US, of course. But you've already seen the ECB talk about QE withdrawal. Eyes are on the Japanese central bank on what they do next, whether they consider an exit from accommodative monetary policy stance. Do you think that the world will really be moving towards a tightening of monetary policy through the course of the next 12 months, which will pressure global liquidity? And so in that scenario, how would you see opportunities as well as risks in the market? Because it would be a very different environment, pretty much similar to what we witnessed in 2006.
Well, that is a good question, but let me explain to you what I think will happen. First of all, the major central banks, the Federal Reserve, the Bank of England, the ECB, and the Bank of Japan, they coordinate their monetary policies. They talk to each other every day. They attend the same conferences. They discuss all the existing issues in the world and so forth. And so the US, when it stopped its QE program, they could let the ECB and the Bank of Japan step in. What then happens is that the euro and the yen weaken in terms of US dollar. And when these currencies weaken, institutions and individuals in these countries will obviously buy US assets because of the appreciation of the US assets against their own currencies. So actually, indirectly, there hasn't been a tighter monetary policy in the advanced economies of the world. It's just been shifted from the US to the ECB and to the Bank of Japan. And when you said before that the US dollar would continue to appreciate, I would essentially think that if the dollar gets stronger from here, the Federal Reserve, and by the way, also the Treasury and Mr. Trump, will go and say, you're crazy to increase interest rates if the dollar is already so strong, because a very strong dollar has an impact on the competitiveness of the US, which is not particularly good at the present time. So my view would be, people have to think it really through. If they bet that the US dollar will be very strong, I think that we'll see in 2017 maximum one rate increase. And that if the dollar is very strong, it could be that the US economy will go into recession. That would be my scenario, in which case we will get QE4 in 2017 and not the 3 rate increases. Let me remind you that at the end of 2015, the Fed predicted 4 rate increases in 2016. We got 1.
Now, the reason I ask you this is because the response to policy action or coordinated policy action from central banks is not only coming in from the developed world, but also from the emerging world. I mean, for example, Turkey, they cut rates in August. Until then, they were cutting rates for a while. But in less than 4 months, they reversed course and have now hiked rates to protect the currency yield. And of course, ensure that that rate differential doesn't narrow significantly, leading to capital outflows. So emerging economies are also responding to the potential of there being aggressive rate hikes in the US in 2017. They're preparing themselves. For the Indian Central Bank also, do you think that would be reason enough to go a bit slow on cutting rates?
Yes, but I'd like to say the Reserve Bank of India has to watch different things. They have to watch the value of the rupee, and they have to watch the rate of inflation and the fiscal deficit and so forth. So they're not only guided, actually, I would say that the Reserve Bank of India is one of the few, certainly under Rajan, was one of the few independent central banks. Very few central banks are completely independent, but the Reserve Bank of India under Rajan was very, very independent. And they did what is good for the average Indian and not what is good for the just 3% that own stocks. Because the majority of people in the world, they don't own shares, but they live their ordinary life. They go to work, they earn a salary, and it's important that the salary, inflation adjusted, goes up and not that stocks go up.
Dr. Faber, thanks very much for taking out the time to speak with us today and share your predictions and thoughts for world markets in 2017. Is there any message or wish that you'd like to give our viewers out there watching you and following your views closely?
Well, I hope that all investors will make a lot of money. But as was the case in 2016, I'm not sure it will happen.
All right, fair enough. Well, we still hope that 2017 is prosperous and rewarding for investors across the world, and especially for our viewers tuning in right now. With that, we come to the end of this edition of World Outlook 2017. Thanks very much for watching the show.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.